So with that, we're going to go ahead and bring Jeff in because we're going to talk a little bit more about these issues in terms of what the heck has happened in the bond and mortgage market over the last couple of weeks since the Fed announcement.
Hey, Art. That's so true. Some of the things you're talking about here, it's crazy that we get good news, but it's bad news. And we get bad news, but it's good news. So, one of the big things is I thought, hey, can we talk about some of the stuff like what's happening with rates? The biggest thing, and I know it was like there was this media selling us this bill of goods now because of the Fed interest rates. They kind of made the general public believe that, hey, when those rates get cut, it's going to help everything, including housing. But I think Jerome Powell was very clear when he talked about it. No, it doesn't work that way. Can you tell us why the rates have actually gone up instead of gone down? Now, I see on your report where the good news is if you have a home equity loan, man, those have really dropped quite a bit since the first of the year.
Right.
But everything else, not so much. So can you help us with that?
Yeah, a couple of things. First of all, on the home equity loans, or in particular the HELOCs, the home equity lines of credit, yeah, those have been helped. Of course, the media doesn't quite make that clear or make that distinction. HELOC is a second mortgage. It's a home equity line of credit. I call it a credit card secured by your house because it behaves in a similar fashion. And the interest rates for those are determined entirely differently than a long-term 30-year fixed-rate mortgage. They're generally tied to the prime rate. The prime rate is directly correlated to the Fed funds rate. So when the Fed lowered Fed funds 0.5% mid-September, HELOC programs, existing loans out there, did or should have experienced a reduction in their rate because of that action by the Fed. So a HELOC loan, yes, there's a direct correlation. Now, when it comes to a long-term fixed-rate mortgage, there's no direct correlation at all, as we've talked about before. And so that's why I always urge people as we approach the next Fed meeting, which, by the way, everyone, the next one's in November, the day after the election. There is talk still that they are going to lower the Fed funds rate again. What's happened with what's occurred since mid-September is the market has sort of recalibrated their forecast for that reduction. There was a point right after the Fed meeting in September that the markets were so enthusiastic that the expectation was that they're going to go another 0.5% lower in November. That's off the table. At best, the expectation is maybe another 0.25% and 0.25% in December. So I think that's still on the table. But what's happening here is this last 2 to 3 weeks has been a great case study for everyone to understand why the Fed should not be the focus when you're looking at mortgage rates and where they're going or where you want to predict they're going. Mortgage rates are all about the bond market, as I've said time and time again. It's all about data points related to the economy and the things that the bond market focus on. And by the way, that the Fed focuses on are really two things primarily: inflation and the labor market. And so the reason why, even though we had that 0.5% reduction in the Fed funds rate in September, mid-September, the reason we didn't see mortgage rates fall is because soon after that, we had a labor market data point released, the jobs market. This is as of tomorrow, it'll be 2 weeks ago. And it came in substantially higher than forecast. It was supposed to be 150,000 new jobs. It was 250,000 new jobs. That was a big, what the heck is going on moment, because that was way beyond what was forecast. And the markets, particularly the bond market, reacted accordingly. Why would the bond market care? Well, the idea is if you have that many new jobs added to the economy, that's probably going to mean that there's going to be more dollars out there to spend, and more dollars being spent on products and services can generally mean they're going to drive up the prices. And so that was considered a signal that maybe we're not through with fighting inflation. And in fact, inflation could reverse course and creep back up when you have that many new jobs created, putting that many more spending dollars into the economy. So that's really a simplified version of how the market reacted and why mortgage rates, well, actually starting with bond yields, and therefore mortgage rates went up after the announcement, not after. And again, I've said on this program to everyone before, the reason there's such a correlation with the bond market and mortgages is most mortgages made in the U.S. are collateral for bonds. They're called mortgage-backed securities, or Ginnie Mae, Government National Mortgage Association securities. And so because mortgages are the collateral for bonds, that's why there's such a correlation between the bond market and the mortgage market, and therefore mortgage rates. And then compound the jobs report from 2 weeks ago tomorrow with this week's inflation number, at least today's inflation number. That's another focus on, wait a minute, maybe the inflation fight is not quite over. Maybe it's ticking back up, and that may give the Fed pause from being too aggressive on lowering the Fed funds rate further. Now, I think after that initial reaction this morning, it's calmed down a little bit. I think the quarter point in November, quarter point in December is still on the table. But that's barring any other economic data points between now and that first week in November that might again underscore that maybe the labor market is not only solid but strengthening. And if we have any more inflation numbers that tick upwards even more, then that's the watch out for.